Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, another big week for earnings after a period of market uncertainty driven by concerns over tech valuations and the conflict in the Middle East. Now, we'll discuss all of that and more in a moment with Wei Li, Global Chief Investment Strategist at BlackRock. But first, HSBC has announced a fresh stock buyback and raised its cost-cutting target as it reported second quarter earnings that actually beat estimates. Now, the strong results come despite the bank facing a crackdown by China on cross-border wealth flows.
We're growing across all our indicators, our revenue growing, our loans and deposits are growing, our fee income is growing. We generated returns of 19.5% on tangible equity. So this is a good demonstration of strong business momentum. We're also very pleased with the progress we're making on the strategy, which we're executing with precision, with discipline, and at pace.
Well, let's get more now with Tom Metcalf, Bloomberg's managing editor for finance in Europe, the Middle East and Africa. Tom, good morning. So talk us through the earnings.
Yeah, I mean, look, pretty bullish tone struck by HSBC, as we just heard there from the CEO. And, across the board, largely beat estimates, relatively good news on the buyback. But, of course, this is all against the backdrop. Bank shares, broadly speaking, have risen quite substantially over the past period. And, effectively in HSBC, while there was no nasty surprises, there was probably no shock and awe. Wow, look, this is a really positive new development. So shares sort of muddling along, I'll describe it today. But, HSBC will probably be pretty happy how this quarter has gone.
Is this thanks to the chief executive and his restructuring efforts?
Well, certainly that was the big message is, hey, that strategy is starting to bear fruit. We're getting near the end of what we think are, kind of necessary divestments. So, he mentioned that basically in terms of our sort of footprint, he thinks HSBC is nearly where he views it as necessary to be. This comes off, they recently just sold the Egypt unit, for example, which sort of puts a cap on many of those divestors. So there's that. And then, broadly speaking, as you look across the bank, most business units were performing sort of in line with estimates as expected. So it does seem, El Hedri's, doing a pretty good job of kind of pushing this huge behemoth of a bank in the right direction.
Tom, as ever, thank you so much for joining us. Terrific briefing there from Tom Metcalf. Now, we're also joined by Wei Li, Global Chief Investment Strategist at BlackRock. Wei, when you look first, we've been really through a lot in terms of earnings season. Mm-hmm. Is there a common thread? It feels like actually companies in general are doing better than expected. Certainly the banks are.
Yeah, the banks are doing well, and I think this environment of higher rates and market volatility definitely help with their bottom line. And the bigger picture is that earnings are strong. Earnings are broadening out as well. And now we have had a period of kind of market positions being washed out a little bit and a bit of deleveraging. I think it is time to focus on fundamentals, and fundamentals are holding up.
And so in terms of fundamentals, what does it mean for the industries that you want to be invested in?
Well, right now we're still overweight the AI theme. Yeah. When we look at AI fundamentals, you look at order book visibility that is extending into the next few years, and demand continues to be very strong. Adoption is accelerating. So certainly the fundamentals look good, supporting our overweight in the AI theme. Now, having said that, risks have risen as well the last few weeks. The first risk is the risk of commoditization. That applies to both the model layer, but also the chips layer, as it seems. And the Chinese equivalents do not need to match the frontier to be commercially relevant. We could see pricing power pressure for the leaders, as well as, this would have consequences on their kind of peak cycle profitability. But I would say that this risk is more around kind of how profits are being distributed and redistributed across the layers, rather than kind of impacting the broader AI conviction, because if anything, commoditization could accelerate AI adoption. The second risk that has risen is risk of capital capacity. If you look at greater sovereign financing needs together with accelerating AI investment, all of that happening against the backdrop of intensifying competition for physical resources, pushing up real rates, pushing up term premium. So that higher rate environment raises the bar for fundamentals to clear, and that's another risk that I think has intensified the last few weeks.
Wait, going back to AI, we've seen these bouts of volatility, or an earnings report that didn't really go to plan, too much capex. Is this an opportunity to buy some of the stocks, or do you just stand back and watch?
Well, we definitely continue to hold our overweight, so we have not changed our conviction in the overall AI thesis. If anything, markets becoming a bit cheaper because of recent correction, and also some of the leveraged positions being washed out is positive for kind of positioning in the near term. But as I said, the two risks that have increased the last few weeks means that we're not adding to our conviction, but we're staying overweight.
Wait, overall, I mean, the U.S. economy is pretty strong, is holding up, but a lot of it, again, has to do with this CapEx spending in AI. What does it mean for other industries that are very focused on the U.S.?
I would say that if you look at the CapEx trend, yes, AI-related names, you see CapEx increasing, being revised higher and higher. But CapEx trend for the broader economy and markets have actually been going sideways and even kind of going down in certain areas. So you really see this competition intensifying and AI CapEx coming at the expense of CapEx in other sectors, but also at the expense of buyback, for example, right? So we do see it's not a zero-sum game, but definitely the competition is intensifying, and that is really setting the backdrop for rates, which has catalyzed a lot of the announcements and developments the last few days.
What's your take on yen? I mean, this is the story that we've been following really closely. First of all, about U.S. intervention. I don't know whether that is a template of actually how we're expecting the Treasury Secretary to act in the future. And what do you think happens to yen from here?
The bigger context for the yen intervention is the rate backdrop. So if you look at U.S. long rates, 30-year hitting the highest since 2007 last week after FOMC, that actually is triggering the immutable law, which is funding cost for U.S. government, and that creates pressure, both political and economic. And since then, we have seen the yen intervention. We have also seen Middle East talks restarting, and on Friday we had this almost strange headline of kind of floating the idea of reducing the frequency of FOMC. So you do see lots of kind of evidence of immutable law, of the higher rate environment influencing and impacting policy steer. So that's the bigger backdrop, but the even bigger picture is that for years now we have been talking about this word shaped by supply and how accelerating AI spend into greater competition for physical resources, pushing up higher rates. So this year some of these developments accelerated, but they are not new.
So when you look at treasuries and the move that we've seen actually for global bond markets, is that symptomatic of what you're saying?
100%. We have seen meaningful repricing in rates the last few years and accelerating this year, but it's just kind of prolonging, it's extending the trend that we have seen for a long time. And that means in terms of the role for treasuries in portfolio, it's less of a diversifier in this environment, but more of an income provider. And the higher rate environment also raises the bar for risk assets to clear.
Okay, wait, don't go anywhere. Wei Li from BlackRock stays with us because we'll talk about inflation and we'll talk a little bit more about the Fed next. But President Donald Trump has threatened consequences if his latest offer of talks with Iran don't result in a deal.
Well, you don't know. I don't know. I think we're going to maybe get something, but I want to give him every last chance before decapitation. It's very tough to do what we have planned, still planned. We'll see what happens. But it's a very, very tough thing to do. I think I'm very proud of the fact that I'll give people a chance. This is a big move. To do an attack that big on a country, I'd rather not do it.
Well, Tehran has denied negotiations with Washington. They're denying that these talks are taking place, but says that talks with Oman to get more ships moving through the Strait of Hormuz are making progress. Now, for more, let's bring in Paul Wallace, our managing editor for the Middle East and North Africa. Paul, good morning. So are there any signs that we could actually see a deal between the U.S. and Iran?
Hi, Francine. I think the first thing we have to see is actually a deal between Oman and Iran. That's what things hinge on at the moment. So Oman and Iran are talking to each other about some kind of deal that will essentially allow for more traffic to go through the Strait of Hormuz. It will likely be a short-term deal. If they can get that, then the attention turns to Trump and whether or not he's satisfied by whatever they come up with. He is asking for a total and immediate and full reopening of the Strait of Hormuz, and he's implying he wants that as soon as today. He's, signaling that today is pretty much the last day before he does launch those massive strikes that he held off on over the weekend. He's very unlikely to get a total reopening of the strait straight away. So I think if Oman, which is essentially trying to appease both Iran and the US, can get something that does allow for traffic to pick up, and that is good enough for the Americans, then yeah, we will have a deal of sorts, a deal that sort of takes us back to where we were in mid-June when the interim peace deal now collapsed was signed. So that's, I think, sort of the best we can hope for in the immediate term.
But Paul, what would that actually look like? Again, I mean, what does it mean for Hormuz? Do you have to, to pay the Iranian Revolutionary Guard if you go through Hormuz? It's unclear what a deal would look like that the U.S. would accept.
Exactly. It's very unclear, and this is another big question. What would it look like? Iran has been pretty consistent in saying that it must, or that it has the right to control traffic going through the strait, and that thus it can charge fees of some kind. So it's possible that any deal Oman gets through today or in the next few days does allow in some way for Iran to charge ships fees. That is, of course, what America does not want. America and most Gulf Arab states and European nations and Asian nations, effectively most of the world, are saying that can't happen, that you have to have free passage through this vital waterway. However, they may just, including the Americans, may just accept a short-term deal that gets traffic going again, even if not at the levels that we saw pre-war, and that keeps ships safe if it allows the US and Iran to go back to formal negotiations. So whatever Oman can come up with today will be messy, and it will leave a lot of questions unanswered, and it certainly won't be, a full reopening of the strait, but it may just be good enough to sort of tide things over for the next few weeks.
Paul, thank you so much. Paul Wallace there in Dubai. Now still with us, Wei Li, Global Chief Investment Strategist at BlackRock. Wei, sometimes the markets got ahead of themselves and they were expecting a deal when actually we felt, when you speak to the military folks or diplomatic folks, that it was very difficult. But what's your take on oil overall right now?
Well, so far, the Strait of Hormuz has been closed for quite a few months now, and macro damage is accruing. Our estimate of the impact for this year is global GDP taking a hit of close to 0.5%, and inflation being pushed higher by north of 1%. So that is actual macro damage that we should expect for this year. And the physical supply disruption pushing oil price higher over the longer term comes on the back of broader world shaped by supply framing that we have been talking about for the last few years. So all of that is kind of accelerating the trend that we have seen for quite some time now. But I would say that, you talked about a deal being very, very difficult. I think really understanding kind of the immutable laws governing kind of rhetoric and policy steer is a good framework. So, we just talked about kind of the yen intervention, and the slightly more reconciliatory tone on the Middle East front should also be viewed in the context of higher rates, long rates pushing multi-decade high, and that actually is a tangible, immutable kind of governing force, the cost of funding the U.S. government, that could influence policy outcomes. So pay attention to long rates is how we kind of evaluate the bigger picture too.
What are you expecting in terms of non-farm payrolls?
Well, U.S. labor market has been somewhat resilient, really resilient. All these talks about AI displacing jobs is not really showing up in the number, and labor market remains to be really tight. You look at unemployment rate, so elevated wage pressure still points to inflation over the longer term settling closer to 3 rather than 2, and that together with the ongoing physical disruption is why inflation is rates staying elevated in our new regime framing, and that is also why the job for central banker is so much harder.
Are you expecting the Fed to raise rates?
We are actually of the view that they could stay put. I know market has gone through a wild repricing, supply disruption, leading to markets to reprice more hikes versus cuts at the beginning of the year. But there is a huge amount of uncertainty in terms of the reaction mechanism of the Fed under wash, and the reducing of the forward guidance does not help in that regard. So that, together with greater inflationary risk and uncertainty over reaction mechanism, is why we think that even if policy rates does not go much higher, term premium needs to reprice higher, which we have already seen.
As always, thank you so much for joining us, Wei. We went around the world in 17 minutes, so we did quite a lot. Wei Li, Global Chief Investment Strategist at BlackRock. Coming up, Spain says nearly everyone who illegally crossed into the African enclave of Ceuta last week has left, as EU leaders prepare to hold more talks on the incident. Details ahead, and this is Bloomberg. Welcome back, everyone. Well, U.S. and Japanese officials have warned investors that they're determined to keep defending the yen after jolting currency markets with their first joint intervention in 15 years. Japan's finance minister has sidestepped a question on whether the U.S. helped strengthen the yen out of concern over Tokyo's financial markets. Well, let's bring in Ven Ram, cross-asset strategist at Bloomberg MLive. So good to speak to you, Ven. So is there a chance that the yen could push higher in the coming days in response to the intervention?
Morning, Francine. So far, the evidence looks flimsy that it will go higher because, what ails Japan is not its currency being undervalued. Yes, it is a problem that the currency is undervalued, but it's not the fundamental. There are fundamental reasons for that. And one of the biggest reasons is the fact that the Bank of Japan is keeping rates artificially lower when it should be sending rates higher. And that is unless they cure that problem, I think that the yen is going to be flailing about. We've already seen it go below 157 per dollar after moving higher. So the markets are really saying, you know what, you can do all the intervention that you can mount, but it's not going to help the yen beyond the short term.
So we've also reported that the Treasury Secretary called for the Fed's help to defend the yen. This feels unusual, then.
Yeah, it does feel unusual, and it's not every day that the Treasury Secretary jawbones the Fed to be intervening in the markets, or at least help another country intervene in their markets. But I think that, it shows what is really at work here, because the Treasury used the exchange rate stabilization fund to prop up the yen, but those funds are very limited in amount. The U.S. currency hoard is just about under $40 billion, so they don't really have too much to spend, so they need to rely on the Fed to supply those swap lines. Mm-hmm. And basically what the Fed is saying is, look, we can't afford the Japanese authorities to be selling treasuries, which they need to raise funds to rescue the yen. So basically, it is a very self-oriented defense, meaning they don't want Japan to be selling treasuries here.
Then it also seems that longer-dated bonds have been selling off everywhere, right? We've been reporting. Do you think there's any place to hide?
There are not too many places to hide, but Germany is one of them because, the ECB, unlike the other major central banks, has already raised rates in response to the second-round effects of inflation stemming from the Iran war. The Bank of Japan has also raised rates in June, but that is already, as we discussed just now, they're already behind the curve, whereas it's not the case with the ECB. If you look at the Fed, Francine, if you look at the Fed and the Bank of England, they're both trailing what market expectations are in terms of vis-a-vis the rates, and therefore their bonds are being punished as well. So if you look at the worst performing bond markets this year globally among the G4 economies, it's those of Japan and US, with gilts not faring far too behind. So the only place to really hide is Germany, and that's a relative play.
Ven, thank you so much. Ven Ram, there are MLive cross-asset strategist. Now, Spain's foreign minister said nearly everyone who illegally crossed into the African enclave of Ceuta last week has left, pledging to return every last person to Morocco. Yesterday, EU ambassadors expressed solidarity with Spain, while the EU Commission President Ursula von der Leyen said the country managed the situation efficiently and effectively. Well, we're now joined by Susan Lynch, our Brussels bureau chief. Suzanne, good morning. So, have we actually seen a shift in tone from the EU?
I think what we're seeing is the EU trying to effect a shift of tone. I think it's fair to say that Spain in particular and other observers were quite taken aback by the scale of the reaction to the events we saw late last week, where a number of European leaders kind of piled in, if you like, on Pedro Sanchez, the Spanish Prime Minister. They were very critical of what they were seeing happening, and they called for Spain to do more. Over the weekend, we saw a series of letters. 22 leaders signed one letter. Sanchez wrote his own letter, and they all wanted this meeting that's taking place today. Now, we know that EU ambassadors met yesterday, and they did thrash out some of these ideas, and there was expressions of solidarity with Spain. What happens today when the actual ministers, the interior ministers, get in that virtual room remains to be seen. But we do expect the Spanish minister to strongly make the case that they've done what they can do, that their border controls are working. There are also unanswered questions about how this happened. So significantly in that letter that you mentioned that Ursula von der Leyen sent yesterday, she did talk about the importance of early warning systems, for example. So that may be the kind of themes that we see the ministers discuss today when they meet.
And meanwhile, Suzanne, the EU is also facing another crisis as, of course, extreme weather threatens to disrupt a crucial trade route. Like, what can you tell us about that?
Yes, obviously, elevated temperatures are having a massive impact in all kinds of ways across Europe. And now the focus is very much on these low, historically low water levels in some of the key waterways throughout Europe, particularly the Rhine River. That's around 1,300 kilometres stretching from the Swiss Alps right into the North Sea, a hugely important commercial thoroughfare there. And because of these low water levels, it's really put a squeeze on that transport link. And we have been tracking ourselves in Bloomberg that the cost of transporting diesel, for example, has really increased. So that's one part of the problem. Then further southeast in Europe, there's a huge impact now on energy. Hungary has been struggling with those low levels in the Danube that runs through around 10 countries, that now they're having problems cooling their own nuclear plants, and that is having an impact on energy supply. So we've been seeing a repression of energy coming from that plant, businesses, consumers cutting their consumption. So we expect further updates on that today.
Susan, thanks so much. Susan Lynch there, our Brussels bureau chief. Coming up, it's been a roller coaster year for oil driven by conflict in the Middle East. Of course, we'll discuss all of this next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. HSBC announces a fresh stock buyback and raises its cost-cutting target as it reports on earnings beat. President Trump says his offer of talks is Iran's last chance as Tehran denies negotiations with the U.S. are actually taking place. Plus, SpaceX is set to report its first-ever quarterly results today after the company's blockbuster IPO. Now, more on that top story now, and HSBC has reported second quarter pre-tax profit that beat analyst estimates and announced fresh stock buyback. Now, the bank said it would purchase as much as $1 billion of shares as it reported a $10.1 billion pre-tax profit for the 3 months to June. Well, earlier, I sat down exclusively with the HSBC chief executive, Georges El-Hedry.
We're growing across all our indicators, our revenue growing, our loans and deposits are growing, our fee income is growing. We generated returns of 19.5% on tangible equity. So this is, this is a good demonstration of strong business momentum. We're also very pleased with the progress we're making on the strategy, which we're executing with precision, with discipline, and at pace. and we've upgraded some of our strategic deliverables, including simplification-related saves, and just announced 3 more non-strategic exits over the last 10 days. That's 15 exits since 2025. And all of this is giving us capacity to invest, capacity to accelerate our investment. And finally, let me say we're very confident in the potential of this bank. We're very confident in our ability to unlock it. We are now a leader in a number of areas where we're operating. We're the Asian leader in wealth management, the World Trade Bank. And we have structural growth opportunities along our footprint. I mean, Asian wealth, Asia buys Asia, the UK growth opportunities. So we're pleased to put more of our strength at the service of our clients.
Do you think a possible UK tax on banks is a possibility?
Look, that's a matter for the government. What we're really focused on is supporting the government and the government's intention to support growth in the UK. Now, if you want to achieve growth in the UK, you need businesses that are investing. You need confidence. For businesses to invest, they need to be able to access financing. For them to be able to access financing, they need a strong, well-capitalized banking sector to support them. So our role, UK is extremely important for HSBC, it's a home market. Our role is to support all businesses across the UK. We support around 700,000 SMEs in the UK, across the UK, and we've grown our lending to them 12%. We've grown our lending to all business in the UK about 10% or $10 billion US. We already pledged another £5 billion of investments to support SMEs in the UK. All of that is what is supporting, or hopefully supporting, that growth that we wish for the UK.
Can you talk to me a little bit about AI? So Bill Winters of Standard Chartered last week said that they were using a combination of Chinese and US AI models. What are you using?
We're using a broad range of AI models. We're investing in a broad range. We're partnering with a broad range of AI partners, investing in a broad range of AI models, but we're doing so thoughtfully and strategically. We're deploying AI responsibly and safely. And we have now multiple hundred use cases, either in production or in pilot stage, and we're seeing real benefits. I mean, in coding, we're seeing in areas productivity up to 300 to 400% higher. In hyper-personalization of service to clients, we're achieving great benefits. Now, more than 2,000 of our wealth relationship managers have access to AI tools that help them hyper-personalize advice to clients. And we've rolled out productivity tools and productivity capabilities to more than 200,000 of our colleagues, helping them in their day-to-day needs.
Are staff worried actually about redundancies, about being able to apply these models, and how do you handle that?
And the important thing for us is make available to all our colleagues both productivity tools, but also training materials and knowledge management materials, so they all individually can become more productive and more impactful in the way they do business for our clients.
Well, that was the HSBC Chief Executive, George Al-Hedri, speaking to me a little bit earlier this morning. Now, oil rose after its biggest drop in a week as President Donald Trump said his latest offer of talks is Tehran's last chance and that he expects a full reopening of the Strait of Hormuz. It has been, understatement of the year, a volatile year for oil. And our next guest says energy markets have reached, quote, a precarious moment. We're now joined by Greg Sharenow, Commodities Portfolio Manager at PIMCO. Greg, thank you so much for joining us. Now, first of all, how should investors position themselves, overall in commodities in such a volatile market environment?
Well, I think the easiest thing you can do from an investor standpoint is to look at portfolio diversification. And if you look at the last 7 years, we've had a series of rolling supply shocks. Yep. Some of the greatest diversification you can have is actually in the commodities themselves. If you look at the correlation to nominal bonds, you look at correlation to equities, no other asset class, particularly liquid asset classes, have provided that level of diversification with similar level of returns as the majority of the equity indices, and obviously outperformed nominal bonds in the last 6-7 years.
But what's the market been like to trade?
Exhausting. I mean, it's a 24-hour, 7 days a week. Bloomberg reporters are working the same hours as I'm working, to be honest. I see them posting at all hours of the day on different things in the markets. It's opportunities, though, in the volatility. We're seeing dislocations in physical markets that we had never really seen before. So there's pitfalls, obviously, in the sandboxes that turns into quicksand real quick. But there are challenges that investors face in their portfolios. There's challenges that traders face in moving physical oil. There's challenges in businesses in planning for an environment that this volatile. So it is an interesting period of time in my career, nearly 30 years of this.
Greg, are global oil markets still drawing down inventories because of what's going on?
Absolutely.
With the Iran war?
Yeah, absolutely. We are in a state of deficit. Now, the size of the deficit is moving in the order of a couple million barrels a day, depending on the flow of Hormuz, which, when I started my career, 200,000 barrels per day, we would debate forever because that was what the price determinant is. Now we have a couple million barrels a day differences between our view on what China is going to import in a month or what Hormuz is going to flow. Like, this is unprecedented and uncharted times. But yes, we are absolutely in a state where the market remains in a deficit. You can see it in the positive carry in the market where people are paying physical premiums for immediate delivery. Yep. And that is a sign of a deficit market.
I mean, geopolitics is changing, not day by day. I feel like, we start the show saying one thing and we finish it saying something else. It's almost on an hourly basis. So how difficult is it to track that, actually, inventories?
Well, tracking inventories, like you have a mixture of satellite data that you don't, you can get daily or multiple times a week updates on. Other than that, we are all tracking developments in the news flow, whether it be renewed attacks on ships while these negotiations are going. On one hand, you're excited and people are hopeful over the weekend that maybe there would be a positive event that gets you more flows out of the Strait of Hormuz, and then you have the realities on the ground. So we always have to mix and understand the sentiment changes versus what's actually physically changing. And that's where there's been oftentimes big differences and big opportunities.
How do you see global oil demand, and what do you think that tells us about the strength or weakness of the world economy?
Well, if anything, I feel like it's been remarkably resilient through this period of time. Like, yes, we know Southeast Asian demand pulled back initially, when jet fuel was trading $260 a barrel. I mean, these are numbers I never imagined before. Like, you were looking at discouraging demand, and frankly, the refined product markets are trading at record premiums. So jet, diesel, gasoline, the things we care about as consumers are trading at record premiums to crude oil because that is where the real physical constraints are. So the market is trying to slow demand, but the global economy itself has proved remarkably resilient throughout this problem, in part because we have some really, really big tailwinds on the CapEx cycle.
Greg, why did so many people get that so wrong?
Well,
2 months ago.
Well, I think we underappreciated, and myself included, the anchoring effect of the fact that, like, if we had the Strait of Hormuz back open and flows had normalized, we'll be back in a surplus, which we were in the fourth quarter of last year and entering into this war. And the other part is whether or not the stomach for politicians to risk having prices go to levels that we hadn't seen before and strangling the economy. Like President Trump directly referenced past presidents who've run into these sort of supply constraint issues and trying to avoid it. So I think that's the other reason why crude oil has managed to maintain a $90 price, $80 to $90 region for the most part. But refined products is where the rubber's really hitting the road, and that's where the stress is showing.
When you look at, maybe the end of the war, and I don't know how far that is, what does it mean for OPEC Plus and actually some of the supply, the supply coming on the market?
Well, it's critical to know at the end of the day what is the damage done to assets. Like, we were talking at one point about flow, but when we were sitting there on Friday and reading the dispatches from embassies in the Middle East on Saturday, my first concern, besides humanity and really hoping that people don't, the loss of life and the realities of that is avoided. But at the end of the day, my second question after that was, are assets being impacted? Are we getting like Ras Laffan in Qatar, for example? And the damage done there is a couple years of delay. We now know there's delays in the expansion of the products. Well, what happens if you have more attacks on actual energy assets? Because that could have a tail that is very long, and that would be the thing that unmoored oil prices. So those are the questions we're asking.
But you could also have a kind of supply glut in 2027. So I don't know whether you're looking at OPEC needing possibly to cut supply going into that.
I think we have a long way to go before we even start rebuilding the buffers in the system to worry about that. And I think that political dynamics in the Strait of Hormuz are likely to have a very long tail, particularly if Iran maintains its view that it's going to have ultimate control over the straits. Yep. I think we'll have episodes of potential calm, and then who knows what comes after that.
So how do you build a portfolio around this?
Well, in terms of trading commodities, like obviously it's a more dynamic environment than may have been in the past. Yeah. But in terms of creating strong and resilient portfolios, I think asset allocation is the primary crutch to lean on. And in that place, you say commodities are diversifying. They've been beneficial for portfolios. They have a positive carry in the market right now, which, you know, if you're thinking about a hedge or something that is diversifying portfolio, and you can have positive carry to the tune of about 1/3 of the vol of the asset, like that's a very good thing. So I think our investors, when I look globally, there's a much greater demand for real assets, particularly liquid real assets, because illiquid real assets traded with a massive duration, and the illiquidity was a big issue.
I mean, what happens to gas in all of this?
Are we talking about European gas? I think.
Well, European gas is through the roof.
Yes.
But also, you know, some of the LNG exports.
I mean, the big problem is for LNG in the long term is that we can build pipelines to move crude oil out of the other areas and potentially avoid some of the greater constraints of the Strait of Hormuz. We can't do the same with LNG. Maybe we can pipe the gas and build new LNG plants elsewhere. But I think the tail risk or the long problems with LNG that it faces is that if we don't normalize flows, and 2 Qatari tankers were potentially hit in the last week alone, if you don't normalize those flows, like the global LNG market will remain much tighter than it would have been before, given the expansions were expected from the region. It's tough to avoid. And when you're looking at Europe this summer, we're not rebuilding inventories. We're going to enter winter with the lowest inventory coverage in decades. Like, that is a very precarious situation. So this is a market that is, I think, probably almost at greater risk in the next 3 to 4 months than oil is in terms of having a real problem.
So interesting, Greg. Thank you so much for joining us.
Thank you.
Greg Sharenow, Commodities Portfolio Manager at PIMCO. Now, BP has posted its strongest quarterly profit in more than 4 years. The oil major saw its refining and trading businesses drive growth as the Iran war pushed oil prices higher. Well, the chief executive, Meg O'Neill, told us she's positive about the outlook.
When we look across our upstream, we've got very high-quality assets in the U.S., both onshore and offshore. We've got 2 very significant capital projects underway in the Gulf of America as we speak. Production from those fields, those developments, will be online in 2029 and 2030. We've got additional developments in the gas business in places like Indonesia and Trinidad and Tobago. Again, those are starting to come to fruition. We've got an opportunity in Venezuela, and we're looking at additional opportunities in Venezuela. And then we've got a very significant discovery that we made in 2025 offshore Brazil. Now, we'll be appraising that opportunity or that discovery later this year, early next year, with the intention to be bringing that forward. So we've got this nice cadence of growth opportunities that will be bringing new production into the group, you know, starting 2028 and stepping forward from there.
Okay, and Meg, thinking about the asset sales, you said just in the last few days that BP is going to be putting up its North Sea assets up for sale. What has motivated that decision, and is there anything that the current UK government can do to change your view?
Yeah, that's a decision that was not made lightly. The North Sea has been part of BP's history for more than 50 years. And the rock quality is still good. We still think there is untapped oil and gas potential in the basin. But when we are really rigorous and we look at the data and we ask ourselves about free cash flow generation, return on investment, resilience through a low price scenario, and we look at the UK North Sea, it just is not competitive within our portfolio. Now, that said, we've had plenty of companies come knocking at our door, expressing interest in buying the assets. So I am confident that the fields will continue to be well managed in other hands. But it's simply a question around capital discipline and capital allocation within BP.
Well, that was BP Chief Executive Meg O'Neill speaking to Bloomberg's Anna Edwards. Now let's bring in our energy reporter, Mitchell Furman. Mitchell, thank you for joining us. So what have we learned actually about BP and its longer-term strategy from these results?
Yeah, we learned that BP plans to bring down its net debt sooner than expected this year rather than next. And at that point, it should give BP some optionality about whether they want to resume their share buybacks, which they suspended earlier this year. They're the only big oil super major without a share buyback program. And so really that's the focus. This chief financial officer, I just got off a call with her and Meg O'Neill, and they declined to commit to restarting the share buybacks. Their focus is paying down debt and improving the balance sheet for now.
How does BP's decision to sell the biogas business fit into its strategy?
Yeah, BP is strictly focused on oil and gas now after years of low carbon ventures. Archaea was squarely in that low carbon venture period where they purchased it for $4.1 billion in 2022. I asked if they plan to receive anywhere near that, and they said it's too early to say. But ultimately, they're looking to shed their underperforming assets and strictly focus on kind of high returning assets.
Mitchell, I mean, we also saw a surge in profits at Aramco in the second quarter. Did they give us any insight into the impact that the war in the Middle East is having?
I mean, Aramco talked about how they're moving along the East-West pipeline that they've now tapped, and a surge of exports to the Red Sea rather than the Strait of Hormuz, and so that's kind of the priority these days for them, is they're trying to maximize, output there. And there were some impacts in July, which we may find out later, but Aramco said that the disruption or the attacks have had no impacts on these results so far.
Mitchell, thank you so much for joining us. That was our Bloomberg energy reporter, Mitchell Furman. And now President Trump has scolded Chevron and ExxonMobil for their soaring profits after oil prices surged amid the war in Iran. The companies made a combined $29 billion in the second quarter, equivalent to around $318 million a day.
They're making too much money, okay? Based on a shortage, they're making too much money. I don't like it. And I should be the last one to say, because I'm a big free enterprise guy. Chevron, too much money. ExxonMobil, too much money. When you look at one company where they made 12 times what they made the year before, they're going to give some of that back to the public. And they better cut the retail price, the consumer price.
Coming up, after a rocky ride in the market, can SpaceX touch down? A reassuring first ever earnings report today. That story is next, and this is Bloomberg.
A lot of this boils down to customers wanting choice. And the big frontier labs have awesome models today, whether it's OpenAI running on Bedrock, whether it's Anthropic running on Bedrock. Customers really love using those models, but they also like being able to customize models. And so having a broad ecosystem of open weights models, I think is incredibly important for innovation. It's important for our customers. And so you think about things like the Nematron models from NVIDIA, or you think about Kimi 3 or some of the Chinese open weights models. Those really help customers be able to customize to their own data and really be able to innovate. And so we think that it's important to not over legislate there and give that flexibility for customers to use whichever models they find to be the best fit. And that's actually why we really focus on having all of those available inside of Bedrock so that customers can choose which ones they want to use.
Not to over-legislate. I mean, I had a conversation with Jensen Huang the day the letter was posted about why then, what was the rationale. It does seem like the concern is that the US government overly regulates open models. Was that a sort of a motivation for you?
Yeah, I think that's the concern, and I think you just want to make sure that we kind of have an even playing field, and it doesn't mean that there's none, by the way. I think there should probably be the same level of oversight of both frontier models as well as open weights models, and I think we should have a consistent framework, but kind of making sure that that folks realize how important that is to what customers and our industry is out there building on, and that those open weights are a key building block of that, and we want to make sure that however legislation lands, it lands evenly across all of those.
Matt, a question from our Bloomberg Tech audience for you is AWS's attitude towards Kimi K3. The open weight was released July 27th. You know, given the platforms AWS offers, what is the plan there?
Yeah, it's a great model. The team there has done a really nice job, and we see really great performance there, and we'll continue to support in Bedrock offering the Kimi models. I think the interesting thing is also, as you see many of these open weight companies, they're starting to think about how they make money in these models as well, and so they're starting to introduce licensing around some of these open weights models as when customers want to run them in a cloud environment. And so I anticipate that there's going to be a blending of some of these these models too, where these companies won't continue to spend lots of money and then just offer their IP up to the world. They're going to be licensing models. They're going to have ways of making money on those as well. And you're starting to see that with some of the open weights models actually having some licensing around them. And so we'll keep supporting these in Bedrock and working with those companies in order to offer these in the best possible way.
Well, that was the chief executive of Amazon Web Services, Matt Garman. Now, another busy day, of course, of tech earnings. Later, we'll get the first ever quarterly results from SpaceX after the company's blockbuster IPO. After market, we also heard of Palantir, which has raised its full-year revenue and income forecast and reported second quarter sales ahead of Wall Street's estimates. While our Bloomberg senior strategist Neil Campling is here. Neil, every day there's a lot to talk about in the tech world. So talk to me about Palantir. Yesterday coming out with some really good results. Why?
Yeah, I think we've had to put some context around it, but the stock had fallen 40% from its November highs into results. That's the key thing. But they came out with their 12th quarter in a row of accelerating year-on-year sales growth. And to deliver 93% top line growth, that's a pretty big number by any metric. So lower expectations, concerns about AI, concerns about software being eaten by AI, and Palantir have delivered a great print, pure and simple.
I mean, I think the stock price is up some 15% pre-market. SpaceX today, the first time they're reporting since the IPO. What are you expecting?
I'm expecting to hear a lot from Elon's visions over the future. There'll be a lot of focus on the CapEx number. Street's probably around about 18 billion for this quarter, 45 billion for the year. They have great ambitions to get to 80% of revenues to be AI within 10 years. That's going to require a lot of CapEx. So there's a reset in terms of expectations because of the stock price, but I think it's more about the vision because the company's unprofitable and still on a high valuation. So let's see what they come out with tonight. But it's going to be about the statements around the conference call, and I think more so than the individual numbers themselves.
What about AMD?
At AMD, again, it's been seen as a second choice to the NVIDIA AI ecosystem. I think we're here tonight from them about their strong demand still in terms of their platform. But also, let's not forget that they have a core business in the computer processing units, CPUs. They've been number 2 for years to Intel in that space, but they're up to 40% market share. I think they're going to 50%. So look for updates on that piece as well, I think.
Overall, what do you think investors are focused on? I mean, is it really now time to see, these models and these companies generate real revenue?
I totally agree. We've had these big CapEx numbers. We've had some reassurance from the likes of Microsoft and Amazon, but now we're getting these Chinese frontier models that are catching up really quickly. So they need to sort of show some returns on those investments. So they need they've got the revenue growth coming through, but let's see the returns. That's what investors focus on now.
Neil, thank you so much, as ever, for joining us. That was Neil Campling with the very latest, of course, on AI. Now, this is a picture across the board. We do have quite a lot of earnings. We had BP, we had HSBC, and others. Stocks seem to be extending gains for the moment. Investors really turning their focus to corporate earnings after pretty, I'd say 3 weeks or 2 weeks maybe of choppy trading, spurred by concerns over tech valuations, but also the conflict in the Middle East. Again, potential challenge, maybe SpaceX, but we're also seeing, it's going to be a big week when it comes to U.S. data. So watch out for any move in U.S. Treasury. And then, of course, we follow yen with 157.8 in terms of that dollar-yen handle. Up next, a Bloomberg Brief, and this is Bloomberg.